Welcome to the Deep Dive. We're your shortcut to understanding what's really driving the markets. Today, we are diving deep into Group 1 Automotive's Q2 2025 results. It's more than just numbers. It's like a real-time pulse check on the auto industry, both here in the US and across the pond in the UK.
Exactly. And Group 1, being such a major player, gives us a fantastic window into the bigger picture. Things like macro pressures, shifting consumer tastes, regulatory changes. It's all reflected in their performance.
Right. We've got the earnings call info, their reports, and we're here to boil it all down for you, find those key takeaways, because there are definitely some surprises in here.
There really are. It's a chance to see what's actually happening out there.
Okay, let's kick off with the headline figures, the ones that really turn heads this quarter. Group 1 didn't just meet expectations, they kind of blew past them in some areas.
Yeah.
Adjusted EPS, the non-GAAP number, came in at $11.52. That's pretty robust.
Yeah, much better than the street was looking for, which was around $10.45, give or take.
And revenue. Also a beat, $5.712 billion versus the $5.62 billion consensus.
Solid numbers, definitely. But what really stood out, I think, was the gross profit story. Overall, gross profit hit $935.8 million, up a huge 22.1% compared to last year.
Wow, that's significant growth.
It is. And digging a bit deeper, the parts and service gross profit was exceptional, $402.8 million.
Okay.
That's up 27.1% year over year. And even on a same-store basis, which filters out acquisitions, it was up 14.0%. Really strong.
And F&I. Finance and insurance.
Also solid. $237.8 million and 18.8% increase year over year. So good performance across several key areas.
Absolutely. Strong beats, no doubt. It definitely sparked some excitement pre-market when the numbers first dropped. But interestingly, that initial buzz seemed to, fade a bit during the actual trading day.
Right, which suggests investors were looking beyond just the headline beats. They were probably weighing some of the other factors, maybe some of the commentary from management.
Exactly. So even with great numbers, there was maybe some caution creeping in. Let's dig into why that might be.
Yeah, let's unpack that. It's rarely just about the top line figures.
Okay, deep dive time. Let's start with the US. This really was the pillar of strength for Group 1 this quarter. Almost defiantly strong, you could say.
Totally agree. The CEO's commentary was very positive, called U.S. operations excellent.
And the numbers back that up. New car sales, same-store basis, up 6%. That's actually beating the industry average.
And crucially, the profit they make per vehicle, the PRU, held steady compared to the previous quarter. That's important stability.
Yeah, definitely. What about used cars?
Also positive, used volumes were up nearly 4% year over year, and significantly, the gross profit per used car was improving.
Good sign. And F&I you mentioned earlier.
Described as very solid. They saw a $90 increase per unit. Shows good execution in the finance office.
And that after-sales piece, parts and service, you highlighted the gross profit jump. Management called it a bright spot.
They're clearly investing there, too. They've increased their technician headcount by 6% in the U.S., same store.
And they mentioned putting air conditioning in the shops. By year-end, 90% of U.S. techs will have AC.
Yeah, I mean, that's a smart move for retention and productivity, especially in hotter climates. Plus, things like flexible scheduling help, too.
Makes sense. Keep your techs happy.
Definitely. Now, there was also a boost to warranty work. Part of that was an easier comparison because of that big CDK IT outage last year. Remember that?
Oh, yeah. Q2 2024 was messy for a lot of dealers because of CDK.
Right. And on top of that, there have been some recent manufacturer recalls, Tundra, some GM engines, Ford stuff, that also drove more warranty work into the shops.
So a few tailwinds there. But management wasn't purely optimistic, were they? They mentioned some caution.
Correct. They specifically pointed to uncertainty around, quote, new administration's policies and uncertainty for U.S. trade partners. Basically, the tariff situation.
Tariffs. The evergreen concern.
Yeah, it could impact how automakers price things, maybe even demand. So because of that uncertainty, Group 1 mentioned they're deferring some capital spending, reevaluating discretionary costs, sort of tightening the belt a bit just in case.
So, U.S. strong performance, investing in service, but keeping a wary eye on those macro policy clouds, especially tariffs.
That sums it up well.
Okay, let's hop across the Atlantic. The UK sounds like a much tougher environment for them right now.
Yeah, more complex was the phrase used, and I think that's putting it mildly. The UK is facing its own economic headwinds, weak growth, inflation sticking higher than the Bank of England wants.
But there was a specific issue hitting dealers hard, right? The EV mandates.
Exactly. The government's battery electric vehicle, or BEV, targets. Management explicitly called this out as a drag on gross profits. Essentially, the mandate forces dealers to sell a certain percentage of BEVs, and often the easiest way to hit those targets is through lower margin sales to corporate fleets.
So government policy directly squeezing their profitability on new cars.
Precisely. And it's not just that. Their SG&A, cost selling, general, and admin, have gone up as a percentage of gross profit, hit 84.3% in Q2 over there.
Why the increase in costs?
Partly due to new government requirements. Things like insurance costs, wage increases. They estimated about $4 million in extra costs just in Q2 from these mandates.
Wow. So lower gross profit from BEVs and higher mandated costs. That's a tough combination.
It absolutely is, which explains why management has been taking some pretty aggressive action.
Like restructuring.
Yes. They've removed around 800 people from the UK payroll, took a $7.6 million restructuring charge in Q2, and that's on top of earlier charges, bringing the year-to-date total to $18.7 million.
That's significant action. Are they expecting things to improve?
They are. They anticipate positive H2 momentum as they finish integrating some past acquisitions, and these cost actions hopefully start to bite. They even mention more, though smaller restructuring might happen in 2025.
But they're still committed to the UK. I saw they opened a new HQ there.
Yeah, in Milton Keynes.
Yeah.
So despite the current pain, they're signaling they are in the UK for the long haul, but they clearly need to resize the cost structure for the current reality.
Okay, so a challenging UK picture, but with active steps being taken. Let's pivot to how they're managing their money overall, capital allocation.
Always a key area for dealership groups. Their strategy seems pretty clear. Balanced growth plus opportunistic buybacks.
So buying and selling dealerships.
Exactly. On the buying side, they picked up 3 U.S. dealerships in Q2, adds about $330 million in expected annual revenue. These were Mercedes, Lexus, and Acura stores in places like Austin and Fort Myers. Good brands, good markets.
Strengthening those premium relationships and selling.
Also active there, they sold off some underperforming stores and some UK assets, including a couple of Mercedes dealerships in the UK. That took about $175 million in annualized revenue off the books.
So pruning the portfolio while adding strategically makes sense. And buybacks.
Still going strong. They bought back $44.5 million worth of shares in Q2 alone. Year to date, it's $167.3 million. That's roughly 3% of their outstanding shares taken out.
That's a decent chunk. And their balance sheet. How's the debt situation?
No, looks solid. They reported $1.1 billion in liquidity at the end of June. Their rent-adjusted leverage ratio was 2.72 times. That ratio includes their lease obligations, giving a fuller picture of their debt. Seems manageable.
Okay. Disciplined approach there.
Yeah.
Now, looking ahead, what about technology and data? That's huge in auto retail now.
Absolutely critical. They explicitly talked about using tech, using their own customer data, first-party data, and improving processes to cut transaction costs and boost productivity.
Any specific examples?
Yeah.
Like AI?
Yes. They mentioned exploring artificial intelligence, not just buzzwords, but thinking about automating operational tasks, transaction processing, maybe even analysis, and importantly, using AI to improve the customer experience in both sales and service. Imagine getting proactive service reminders based on your driving habits or a more personalized online buying journey.
That's where the industry's heading, isn't it?
For sure. The winners, as they see it, will be the ones who can leverage scale and technology to make everything more efficient, especially as car prices and interest rates put pressure on consumers.
They also mentioned rebranding in the U.S.
Yeah, bringing U.S. dealerships under the main Group 1 banner, kind of like they've already done in the U.K., learning from that experience to build a more consistent brand feel.
Makes sense for scale. And let's circle back quickly to that after sales, the parts and service bit. You said it was a bright spot.
Definitely. It's such a critical profit engine for them. It's less cyclical than car sales, more predictable, kind of the ballast for the ship.
And they have a strategy to grow it further.
Yeah, it's about reaching owners of older cars, think vehicles 4 years old or more, offering them competitive labor rates, using their customer data to send targeted service offers, get them back into the dealership service bay.
And you mentioned the value of a technician.
Right. They estimate, on average, a tech generates about $15,000 in gross profit per month. So you can see why investing in tech's training tools, AC, makes absolute financial sense.
Okay, let's tie this all together for someone thinking about Group 1 from an investment perspective. Why does that parts and service strength matter so much?
Well, like I said, it's the ballast. It provides a steady, high-margin income stream that helps smooth out the bumps from the more volatile new car sales cycle. Especially as those pandemic-era high margins normalize, it's a defensive quality.
And the capital allocation. Buying, selling, buybacks.
That's a key part of the story, too. It shows discipline. They're not just growing for growth's sake. They're buying assets they think offer good returns, getting rid of ones that don't, and returning cash to shareholders via buybacks. That signals a focus on shareholder value.
But the UK is clearly the area investors are watching closely, right? Despite the overall strong results.
Absolutely. It's kind of a litmus test. Can they navigate these BEV mandates? Can they get those SG&A costs under control? The market's somewhat cautious reaction after the earnings suggests investors are maybe taking a wait-and-see approach. They want to see proof the restructuring is working before getting too excited.
And those macro headwinds are still out there. U.S. tariffs, UK economy.
For sure. The tariff uncertainty could definitely influence future vehicle profits. Management themselves said they expect automakers, the OEMs, to react by adjusting things like trim levels, features, and pricing on future models like the 2026s to try and protect their own margins if tariffs bite. It's a constantly shifting landscape.
Okay, so we've analyzed the results, the strategy, the risks. Now, for a bit of fun, the not financial advice segment, purely hypothetical scenarios, right?
Right. Just thought experiments based on what we've discussed. Absolutely not recommendations.
Okay, my first idea. I'm calling it the UK turnaround turbocharge bull call spread. The thinking is, maybe the market is too downbeat on the UK right now. They've made big cuts, new leadership is in place. What if those benefits show up faster or bigger than expected in, say, Q4 or early next year? Maybe better than just smaller restructuring activities.
So you're betting on an upside surprise from the UK restructuring?
Kind of. So maybe an out-of-the-money bull call spread strategy, looking 6 to 9 months out. It gives you defined risk, but leverages that potential positive surprise if the UK turnaround gets real traction sooner than people think. Could lead to a re-rating.
Interesting. Playing for that underestimated catalyst.
Yeah.
Okay, what's your second one?
This one's the aftermarket alpha long stock, short OEM dealers pair trade. The thesis here leans into that super strong parts and service business we talked about. It's defensive, benefits from older cars on the road, maybe even higher repair costs if tariffs push up part prices. It's more insulated.
Okay, so you like that service revenue stream.
Exactly. So the idea is go long Group 1 stock to capture that aftermarket strength. But to hedge against the general ups and downs of car sales, or maybe specific risks like tariffs hitting new car dealers hard, you could short another dealership group, maybe one that's more focused on new cars, less geographically diverse, or has a weaker service arm.
Ah, a pair trade. Isolate the factor you like, Group 1 service, and hedge out the broader industry risk.
Precisely. You're betting on the relative strength of Group 1 service business compared to a more cyclically exposed competitor. Captures that steady service profit while limiting exposure to new car volatility.
Clever. Isolating the alpha, as they say. Again, purely hypothetical trade ideas.
Absolutely. So, wrapping up our deep dive on Group 1, a really strong Q2 overall. U.S. performance was excellent. Parts and service growth was, frankly, exceptional, beating expectations.
Yeah, but the UK remains the challenging piece of the puzzle. Those BEV mandates and cost pressures are real, though management is clearly tackling it head-on with restructuring.
And that disciplined capital allocation of the smart acquisitions, the disposals, the consistent buybacks, that continues to be a core part of their playbook.
But the market reaction tells us investors are still cautious. They're watching that UK recovery, watching the macro factors like tariffs, waiting for more concrete positive signs, perhaps.
So, as Group 1 navigates these currents, the big question hanging out there for you, the listener, is maybe, will this aggressive UK fix turn out to be the right move at the right time, or is it just battling against some really strong headwinds? Something to think about. We hope this deep dive gave you some valuable context on Group 1 Automotive's quarter.
And just to reiterate, this discussion, especially those trade ideas, was purely for informational purposes. It is absolutely not financial advice.
Please always do your own research before making any investment decisions. Thanks for tuning into the deep dive. Let us know what you thought.